Welcome to Taking Stock for the week ending the 16th of July 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, stream to your thing share markets. Normally, reporting season is a volatile time for stocks, but investors can manage this risk by ensuring their portfolios are diversified. For instance, having no fewer than 15 stocks. Also, the majority of the stocks you own should be financially healthy businesses, those with strong balance sheets to help you ride out any negative surprises. For example, just this week, financially unhealthy businesses, Afterpay, Zipco, and Sezzle tumbled on news of Apple's plan to introduce a buy now, pay later scheme. And these companies are modern day lay-by type businesses which allow consumers to buy products now and pay for them later. Now, rising competition in this space is evident and follows on from PayPal introducing its own buy now, pay later model and also removing late payment fees as well. And new entrants into this sector will surely put a squeeze on their future margins. Furthermore, the combination of high valuations and lack of profits are unlikely to sustain the elevated share prices of these stocks.
Yeah, and speaking about valuations, Kien, we continue to observe high levels of takeover activity within our star stock universe. Just this week, Spark Infrastructure, an investment manager that owns infrastructure assets, defended itself from an opportunistic bid from Canadian pension fund, Ontario Teachers Pension Plan, and private equity firm KKR. The consortium made a bid of $2.80 per share, but Spark's management have recommended no action from shareholders, believing the price is undervaluing the business and the future potential.
As a reminder, Jake, Spark rebased its financial year 21 dividend guidance in March following the impact to the company's 5-year regulatory contracts with South Australia Power and Victoria Power. And despite this reduction, franking credits of around 25% will be attached to those future dividends. And positively, dividend growth is expected to exceed inflation from here, with its forward gross dividend yield currently at 5.3%.
Yeah, and we've also seen strong activity from Wesfarmers, which made a play for Australian pharmaceutical industries, or API, to gain a foothold in the health and wellness sector. The $687 million target equates to around 1% of Wesfarmers' market cap, but is in early warning financial health. Investors should note, though, that is small relative to the overall business and is unlikely to impact Wesfarmers' financial health. Wesfarmers includes the likes of Bunnings, Kmart, Officeworks, and Target, and the company has an enormous war chest following its sell down of Coles Group and has no net debt. Wesfarmers is continuing to pursue growth opportunities in niche markets following its acquisition of Catch Group, and this will likely help drive growth, which is expected to slow down in the coming year. The company's on an attractive gross dividend yield of circa 4.3%.
Yeah, and meanwhile, Johns Lyng, a building restoration company, also went on a minor shopping spree with the purchase of South Australian insurance building Unitech. Now, the purchase should introduce some cross-selling synergies into the group and help drive earnings growth, which is expected to remain strong at around 36% in the coming year.
Yeah, finally, Seven Group, an industrials equipment service provider, is still trying to wrestle a stake in Boral. The rationale is Boral will increase Seven's sector exposure to infrastructure without the associated risks of engineering construction. This should help diversify its earnings streams and ensure it takes advantage of the strong government infrastructure spend that's expected in the years ahead.
And COVID has created a significant valuation distortion, and M&A activity is expected to be a key theme this reporting season as cashed-up companies look for other avenues of earnings growth to offset the eventual slowdown from the winding down of government stimulus measures. And another key theme investors should look out for this reporting season is the margin pressure created from supply constraints and rising input costs. Also, be mindful of the uncertainty with regards to corporate outlook guidance, especially with renewed statewide lockdowns in Australia.
Yeah, and moving to star highlights now. In previous weeks, we spoke about the strong demand for motor vehicles and how this should support companies that operate in this space. ARB Group, the maker and seller of four-wheel drive accessories, announced a bullish trading update with second half FY21 profit before tax expected to grow in the range of 17 to 25%, on the first half. This is 5% above expectations and should help alleviate the risk of a negative surprise when the company releases its results. But investors may be aware that earnings growth in FY22 is expected to slow down, and this is based on the expectation that international borders will open, leading to many to relocate their expenditure to international holidays. However, we believe earnings in FY22 will likely continue to be upgraded.
And investors may be wondering why the share price of Platinum Asset Management, and they are a value-based fund manager, dropped so significantly this week. The company revealed a 5% decrease in funds under management, and that was caused by a 1 billion cash dividend to the investors and also outflows of around 167 million on flat market performance. So the market reacted negatively to the update because the majority of Platinum's funds are underperforming respective benchmarks, and as such, we remain cautious on the outlook for fund flows in the near term.
Yeah, and the group is expected to only generate $4 million in performance fees over FY21 compared to 9.1 million the previous year, and this could potentially lead to a decline in net profit margins and return on equity. Additionally, we estimate the group's average funds under management balance for FY21 to come in slightly below the prior year, which may present a drag on Platinum Management's fee income. Collectively, these risks could weigh on the share price leading into the result.
And moving forward, Jake, July represents the quarterly reporting period for many commodity-based companies. Copper miner Sandfire Resources released its preliminary fourth quarter result on Wednesday, and copper production was ahead of the previous quarter, while gold production and cash costs finished FY21 within guidance range.
Yeah, and keen investors will note, Kien, that FY22 earnings forecasts are slightly negative at this point. And this reflects two things. It reflects that the copper prices have reached 7 to 8 year highs this period and could trade off those highs in the new financial year. And also, and more pressingly, De Grauze is approaching the end of its mine life in late calendar year 2022, and mining volumes could drop. But as we mentioned last week, Sandfire has received approval for its Botswana project that could start replacing some of those tons of copper mined and replacing that production from De Grauze.
Also, fresh news as well today. Rio Tinto, an iron ore miner, released its second quarter result with volumes down 2% on the previous quarter. Their full year production should come at the lower end of their guidance. Positively, though, elevated iron ore prices should support its final dividend, with the company on a gross dividend yield of over 16%.
Yeah. Meanwhile, Evolution Mining announced its fourth quarter production update, suggesting that full year production has fallen short of its guidance, and that was due to unplanned shutdowns and temporary issues across 3 of its mines. Consensus is forecasting that earnings growth of 24% for FY21, though after today's announcement, this could be revised lower. But we do expect some of this lost production will be recouped in the following year of FY22. Now, turning our attention to a corporate calendar, Ramsay Health Care will be hosting their AGM on the 19th of July, while some of our miners will be releasing their June quarter updates, with South32 expected on Monday, the 19th of July, BHP on the 20th of July, and both Newcrest and Northern Star expected to report on the 22nd of July. For trend-sensitive investors, the stocks that turned bullish on the SD Max included Lovisa and Credit Corp. Meanwhile, Adairs moved bearish.
And during the week, we initiated coverage of Ansell. For those who are not familiar with the company, Ansell is a manufacturer of rubber gloves and personal protection equipment, otherwise known as PPE, for the industrial and also healthcare sectors. Now, demand for rubber gloves and other forms of protective equipment had skyrocketed as COVID infections placed enormous amount of strain on the medical staff worldwide. And the elevated demand contributed to product price increases, and this is set to fuel a strong financial year 21 result. While we expect earnings to retrace in financial year 22, it should remain well above pre-pandemic levels, supported by a permanent lift in rubber gloves and also a recovery in industrial production and elective surgeries.
Yeah, and a few investors are probably wondering why we've initiated coverage on the company now. before the release of their result. While originally we had concerns around the lower FY22 earnings outlook, however, operating conditions within the personal protection equipment market in recent months has held up, especially on the back of renewed lockdowns in New South Wales and Melbourne. Additionally, management's strong FY21 earnings guidance in April reduces the risk of negative surprises at the time of the result. Hence, we are comfortable with the timing.
And those who are considering exposures to Ansell should understand the active risk before investment. The company is exposed to variable input costs, including butadiene and also natural latex rubber, which can lead to volatile margins. Rubber is sourced from several countries in Asia, predominantly Malaysia, Thailand, and Sri Lanka. And positively, the sum of these risks is mitigated by the partial hedges.
Yet another risk with Ansell, along with many healthcare stocks, is its diverse geographical exposures. Having 46% of its revenue from US markets, its earnings are susceptible to movements in the Australian dollar.
And also, we've just began coverage on Technology One, a mission critical software provider. We'll speak more to that next week. But in the meantime, please refer to our initiation report to understand the investment thesis and the active risks to the business. As reporting season approaches, we want to remind investors of how Stock Doctor can help them manage their portfolios. So the question this week is, how can Stock Doctor help you prepare for the reporting season? And with so many companies reporting their results over a month, it can be difficult to keep track of everything, but Stock Doctor makes it easy. First and foremost, ensure that your portfolios are up to date with the portfolio manager. This includes entering buys and sells correctly, along with any dividends or reinvestment plans that may have occurred over the past year.
Now, once your portfolio is up to date, it's time to set alerts for your stocks. The Stock Doctor Alert Manager will notify you of events that require immediate attention, making sure your portfolio stays in tip-top shape. Alerts can be processed intraday and will notify you within Stock Doctor or via email. It's your choice. To set up alerts, navigate to Alert Manager under Tools. Create a new alert, enter company code and select from 4 alert categories, with some key ones including star stock changes, movements in director holdings, updates to analyst comments, ex-dividend dates, technical price triggers including the SD30 TSR, and valuation changes.
And aside from the Alert Manager, there's also the Corporate Calendar, which provides a window into what stocks are reporting over the next month. Here you can access report dates, AGM dates, and ex-dividend dates. Just to be careful here though, if there is an asterisk next to the stock code, it means the date has not been confirmed with the company and is estimated by our system. And meanwhile, the left-hand menu includes options to filter on companies, watch lists, and events.
Last but not least, reporting season is where our financial health model really shines, allowing our members to quickly conduct due diligence on a company after the release of its result. No other financial health model out there has been back tested with a 95% success in helping investors avoid corporate failures.
And these tools will help you stay on top of your portfolio during the reporting season. And as always, feel free to contact our relationship manager if you need any assistance. There's also a tutorial in our help section as well. But be mindful that the research team will be busy analysing star companies, but we will always return your call. Thanks, Jake, for your time and sharing your insights. I know you'll be preparing for the busy result period ahead.
Thanks for having me on again, Kien.
As reporting season closes in, risk management plays an important role within your portfolio, given that this is usually a more volatile time for star stocks. Take advantage of the tools available in Stock Doctor to help you track your stocks, including the corporate calendar, portfolio manager, and alert functions. And of course, we will be doing the thorough due diligence with our financial health assessment. Take care, everyone, and have a happy, healthy, and prosperous week ahead.